Welcome back to Miller Momentum. Today, we're going to do a deep dive into Alpha Architect's High Inflation and Deflation ETF, ticker HIDE or HIDE for short. Very clever name, by the way. We'll get into the methodology, the marketing claims, and yes, I'm going to show you a 50-year back test. Well, actually 45 and a half year, but close enough. Bottom line, you're going to get a really long back test. Is it a viable replacement for managed futures without the whipsaws and drawdowns? Hmm? Can it actually handle inflationary and deflationary regimes? Great questions. Well, let's find out the answer. But first, I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Okay, so I reached out to Jack Vogel, and he graciously provided Hmm. Anyway, after a bit of back and forth and me missing an appointment to speak with Alpha Architect because I confused Wednesday with Thursday, kind of embarrassing, it became clear that even if we did sit down to talk, they weren't going to budge. They weren't going to give any information other than what's publicly available. And I understand there's probably legal considerations that prevent them from sharing more. But, I went ahead and cracked the HIDE ETF methodology myself for you anyway, because I feel that viewers need to have all of the information to make an informed decision. Because without information, well, that takes the informed out of the decision, doesn't it? So, the elevator pitch for the HIDE ETF is that it attempts to simplify managed futures by focusing on what Alpha Architect considers to be the three core allocations for managed futures. And that would be equities, interest rates, and real assets. And they also seek to eliminate the volatility and whipsaw effects of managed futures by doing long only trend following. So, this one slide that I've got on screen is really the key to understanding their strategy here. And the way that they execute it is they take um, essentially just four ETFs. They've got a REITs ETF, a commodities ETF, and a treasuries ETF. And so for their REITs, they go with VNQ, which is the broad Vanguard index there. For commodities, they go with BCI. And for treasuries, I believe they go with IEF. But, intermediate treasuries are intermediate treasuries. All of the different ETFs are pretty identical. And then they also have a cash position that they use for when an asset is trending downwards. So when they are in a risk off environment for that asset category, so to speak. And I've got this pulled up on the Wayback Machine because this earlier presentation disappeared from their website quite recently, just because they're updating and such. Because, for instance, they had a slide here showing that Hyde was outperforming managed futures and talked a little bit about that. That's no longer the case as of July 2026. Stuff happens. So they just refreshed their slides, updated, streamlined them a little bit. But I like this slide deck from the Wayback Machine, which was snapshotted in February of 2026, because it gives a lot more detail on the fund. And that detail was what ultimately allowed me to reconstruct the fund for you. The HIDE ETF relies on six basic signals. Well, actually, just two signals for each of the three assets that it holds, which would be the 12-month simple moving average and a 12-month momentum gauge. So I've got this entered in as 252 days because That's typically the number of trading days in a year. So we're looking right now at the commodity index, so the 252-day simple moving average. We're just looking to see if the total return of BCI today is greater than its simple moving average over 252 days. And then for the momentum factor, we're just looking at whether the total return of BCI over the past 250 days, or the past trading year, past 252 days, I should say, is greater than the total return of cash over that same period. And the ETF just uses that same set of signals for the other two assets. And so right here, I've got it entered into the BCI, the commodity index, and total risk on would be, well, I hope I'm using that term right. The basically, if there's no risk, right? If things are moving in a positive direction, then if the simple moving average looks favorable and momentum looks favorable, then the fund goes all in on BCI. If only one of the two signals looks favorable, simple moving average or momentum, then it splits it 50-50 between cash and the commodity index. And if both signals look unfavorable, then it falls back to cash. And you can see that, trend following can be pretty powerful here. We can see the BCI index in blue, the 50-50 allocation in red, and the cash only in yellow. And combining the two, and yeah, I didn't update the VNQ here, but this is the BCI sleeve. It's just a naming thing that I forgot to update on this demonstration. Uh, you can see that it's just gliding over these dips, right? See how it's gliding over these dips? So trend following can help. And just because it's bothering me, I'm going to update the name here, make it all pretty, and then run the back test again just so you can see that I am indeed back testing the BCI sleeve of the HIDE ETF strategy here. And I'll put a link to this in the video so that you can come in here and play with this back test yourself and actually get in and create the other sleeves. So I'm just saving the strategy and I'm going to grab the link for you, and that's going to be in the video description. And if you want to test something else, if you want to test one of the other sleeves, all you got to do is switch out your two signals to that other sleeve, just like that, and then update to the right ticker. And I looked up, this strategy is indeed using Schwab's intermediate treasury, which is SCHR, but it's going to be the same as IEF. It really is, because it's all tracking a pretty identical index here. So then you just update, you'd hit back test, and then you could see how the strategy looks for intermediate treasuries. You can see the trend following for that using cash as a fallback has been pretty effective since about 2018. So that's how the signals are reconstructed. That reconstruction actually gets pretty darn close to the actual strategy. You can see our reconstructed strategy in blue, and you can see Alpha Architect's HIDE strategy in red. So the reason for the difference here has to do with two things: fees, trading frictions, and probably a glide path rebalancing strategy. Because when you go up here and you set the drag on our reconstructed strategy to say 1.29, so 1% to account for random friction in trading and execution of the strategy, and then 0.29% because, well, that's the advertised net fee. If we run the back test on that, then we can see that now the strategies are much more closely aligned. There's still some divergence here, but they end up in the same place in the end. And the reason, again, for that divergence is probably volatility dampening strategies and some other fancy things that um, Alpha Architect is doing behind the scenes. But the correlation between our reconstruction and the actual HIDE ETF is about zero point 0.9. So, pretty darn good. We can be confident that this reconstruction is giving us a ballpark approximation of the strategy, and it's going to be accurate in terms of back testing for what to expect. So, how did this strategy look going back, several years? Well, we can answer that. So it's really interesting going back to 2018. We can actually take it back further, and I did. I actually took the liberty of, before recording this video, of creating a hide sim ticker, and it uses IEF, and instead of BCI, it uses GSG as its commodity index, which is slightly different than BCI, but it's got a lot more history. And instead of VNQ, it uses the built in REIT sim ticker from testful.io, which goes way, way, way back. So the main difference between the hide sim that we constructed over here, hide sim, let's call it hide sim 1 for Alpha Architect, and our second hide sim strategy, it's just basically that the second one has a different commodity index. But you can see that the shape of it is actually relatively the same. And hide sim is going to be a little bit higher because, again, you know, uh, we haven't accounted for the drag in the fund, and it's using a slightly different commodity ticker. Now, if we do account for that drag and just set it to 1.29, we can see the two strategies are, you know, they're fairly comparable for a while, but then the commodity index is going to cause some divergence because GSG and BCI, they weight oil a little bit differently. But the cool thing about our longer construction, and I'm going to just fiddle with it a little bit so that it's aligned a little bit better. We can take a conservative estimate here and just say, let's do the same drag, just like so. And then we can get rid of the one that we constructed for Alpha Architect so that we could take this thing back 45 years. So, yeah, it's pretty cool. Almost 50-year back test. Would it have helped during an inflationary period to have HIDESIM in a portfolio? To answer this question, I just took the basic 60/40 portfolio structure with annual rebalancing, and I replaced the bond portion with HIDE, or rather HIDESIM, since the HIDE ETF didn't exist at the time. And looking at the results, we can see that from January 1st, 2021 to December 31st, 2023, just taking all the trading days in there, the 60/40 portfolio constructed with HIDE instead of with bonds did appreciably better in that environment. It had a cumulative return of about 25% compared to the normal 60/40 portfolio's cumulative return of about 9%. During that time, it had a much improved max drawdown, much improved average drawdown. Its longest drawdown was noticeably shorter. Its volatility was pretty much about the same as the 60/40, but its Sharpe ratio was spot on. So, I really wish that we could test this back in the 1970s, but we don't have data for the GSG commodity index going back that far. So 2022 is kind of the best example for a case study on how this strategy would work in an inflationary environment. I mean, other than the inflationary environment we're in right now. So the question is, how would this work in a deflationary environment, right? So we can actually look at that by setting our times to, let's go back to 1998 and then go all the way to the end of 2011. So we can get a good chunk of the lost decade, the whole lost decade, in fact, and a few buffer years on each side of that lost decade for the US market. So this was the closest that we've had to a really deflationary period. And let's see what happened here. So we can see that the HIDE portfolio again does really well, and that is the 60/40 that uses HIDE instead of bonds. Now, I do want to note that the traditional 60/40 did come out slightly higher after the crisis period was over, but during that lost decade, I'm imagining that somebody who held a portfolio with Hyde probably got some psychological benefit from being above the traditional 60/40. The max drawdown is a little bit more severe with the Hyde variant here. The average drawdown is a little bit more severe. And the longest drawdown is comparable. Volatility is relatively comparable. Risk adjusted returns are a little bit worse. So, this is interesting. The HIDE ETF certainly looks like a viable bond replacement, but that's not really the claim being made by Alpha Architect, right? They're putting forth HIDE as a substitute for managed futures. So, is it? How does that look like? Well, it's really easy to take a look. Instead of bonds, let's just switch this to managed futures, and we'll use DBMF SIM. And even though I don't particularly like the index that KMLM uses, we can backfill with KMLM as an index for the years when DBMF is not available, because we don't really have index data available for DBMF in this platform beyond the year 2000. So, this is just the best that we can do. So we backtest again. And so now we've got 60/40. I'm going to label this a little bit more clearly for you so that you can see 60/40 managed futures versus 60/40 HIDE. So someone holding the 60/40 managed futures portfolio would have a moderately better max drawdown than the HIDE portfolio, better average drawdown, comparable longest drawdown, slightly improved volatility, and improved Sharpe ratio. And they'd also have improved absolute returns here from the managed futures option here. So is Hyde a better managed futures replacement? Well, based on this decade, no. But what about during an inflationary crisis? Is Hyde a better option then? Well, let's go ahead and look at it. So we'll do January 1st, 2021 to the end of 2023 again. And here we can see that the 60/40 structure with managed futures significantly outperforms the option with Hyde. It's got uh, significantly higher returns. It's got significantly improved max drawdown. It's got significantly improved average drawdown. It's got a better longest drawdown. It's got better volatility, and it's got a better Sharp ratio. So the evidence and the data would suggest that HIDE is not a good managed futures replacement, although it's an intriguing alternative for a traditional bond allocation like intermediate treasuries. But it just doesn't seem to live up to the claim that it is a good managed futures replacement. The image I want to leave you with is of this full back test going back 38 and a half years, because, well, that's as far back as we can extend managed futures to show the 60/40 portfolio structure compared between managed futures, the HIDE methodology, and bonds. And the contrast is striking. Managed futures is an incredible diversifier over this period. And Hyde, it's it's comparable to bonds. It's actually a little bit better than bonds, but it's not really showing up as a managed futures replacement here. And the individual who allocated to managed futures in the form of a broad managed futures index like fund, like DBMF, came out really well with that 60/40 portfolio structure. In fact, to show you just how well, I'm going to add the S&P 500 here as a fourth asset to compare. So, you know, for a long time, the 60/40 managed futures portfolio was actually above the S&P 500, and the returns are competitive with much better risk adjusted metrics here. I mean, the 60/40 with managed futures has a Sharpe ratio of 0.75 and a volatility of about 11%, compared to the S&P 500, which has a volatility of around 18% and a Sharpe ratio of 0.53. And the 60/40 with managed futures is getting a good return. So, what's the takeaway here? Well, I think, all things considered, it's better to educate people about what managed futures are and their whipsaw like behavior than to try and replace managed futures with something else that tries to give a person all of the benefits and none of the drawbacks, because that's probably impossible, right? So if something sounds too good to be true, it likely is. And I'd rather educate someone that the managed futures portion of their portfolio is going to dip down and up, down and up, down and up, instead of give them a smooth solution, or rather a so called solution to that problem. And it's actually not really a problem, because if you're rebalancing on an annual basis, and especially if you're rebalancing on an annual basis and doing an ad hoc rebalancing on 5% absolute bands, which means if any of your target allocations drifts by 5% or more, you rebalance at that point, even if it's not your annual rebalancing date. The managed futures are going to give you a less risky ride with better returns. So why wouldn't you want someone to have that? I'd rather give someone real security and real returns rather than a false security and just a psychological, um, placebo effect. Whereas their portfolio is actually doing worse than if they went with the perceived to be more risky asset, which actually makes their portfolio safer if they know how to use it. I'd rather educate someone. I That's just my stance. But what about as a bond replacement, right? I said that this looks like it might be a viable bond replacement, and that may be true for broad-based funds like BND or IEF, you know, intermediate bond funds or aggregate bond funds. I think that Hyde as a replacement could possibly work, but it's a lot of trouble to get very similar results, right? Well, what about cat bonds? I love cat bonds. Could it be a replacement for cat bonds? Well, I decided to run the test just in case because, somebody might have that question out there. And the answer is a resounding no. HIDE just has much greater volatility than cat bonds do. It doesn't have the return profile that cat bonds do. So I don't see how Hyde could possibly fit into any of the Miller Momentum portfolio frameworks. And although it's an intriguing broad bond fund replacement option, well, I just can't really see myself choosing it in practice. And there's more to the story about that. And, well, I'll just get into it right now. So, if you've seen my video on EDV versus chaos, you know my reservations about how frequently Alpha Architect radically alters the fundamental underlying strategies of their funds. And I'm not talking little tweaks. I'm talking full reimaginings. I don't think the methodology of the HIDE ETF, based on the data, lives up to its claim to be a viable managed futures replacement. But perhaps more concerningly, I don't have high confidence that the HIDE ETF strategy will remain the same even just a few years from now. And let me give you some context on this. In emailing Jack Vogel about Hyde, the conversation shifted to QMOM, QMOM as some people call it, and IMOM, and how I wished US investors had access to a unified global momentum factor equity fund. And part of that is just me pining for IWMO, which is the iShares Global Momentum Factor Equity Fund that our friends over in Europe have access to and we don't. But anyway, Jack mentioned they don't have plans for a global momentum factor ETF, but last February they did retool AAVM and converted their VMOT ETF into it, and he told me about how they're not doing trend following inside that particular ETF anymore, but now they're trying a dynamic relative strength weighting of their four momentum and value factor ETFs together. And my heart just kind of sank a little bit. My feelings about Alpha Architect are pretty darn complicated. I love their articles and the pieces from Larry Swedroe that they feature and how active they are on podcasts, and they have so many brilliant ideas. I think they're kind, passionate people who truly want what's best for investors. But weirdly, that's likely part of the problem. You see, they are always chasing something they think is bigger and better, which incurs inadvertent switching costs on their funds and overcomplicates things. And as I'll get into in a future video, strategy complexity itself is very, very closely related to poor returns, paradoxically. So it's kind of like the harder you try, the more likely it is you're going to fail and the worse you actually do in practice in the vesting world. I know it's counterintuitive, but I'll get into it in depth in a future video and it'll make sense by the end. Trust me. Anyway, I don't want the funds I entrust my life savings to, well, constantly morph what they even are underneath the hood. And that's part of why I dropped my use of the Chaos ETF, ticker CAOS. And at this point, I can't see any Alpha Architect funds fitting into my four portfolio frameworks at all. I mean, I've already talked about how I'm not really going to change my strategy ever and the importance of committing to portfolio architecture. But if I was starting from square one and I was looking at funds, I wouldn't pick any from Alpha Architect. And if I had, then I would be looking at a systematic exit strategy for myself to move into another fund option that I consider more viable. And yeah, that's just the short and long of it. And regarding AAVM, hmm, I guess you're getting a little bit of a bonus ETF review as part of this video, but I do think that looking at a firm's other ETFs is relevant to assessing how their strategies are going to do overall. Anyway, but looking at AAVM, which is Alpha Architect's global equity ETF, and going with what uh, Jack Vogel said in the email, that the newest strategy kicked in on February 1st of last year. We're just going to compare it to a static allocation of iShares, USA factor, international factor, momentum, and value ETFs at 25% each. And instead of doing, any fancy relative strength calculations or anything like that, just leave it fixed and do yearly rebalancing and see how things have shaped up over the past, about a year and a half. And you can see that just the getting those four ETFs from your big box ETF store of iShares, and they really don't tinker with their strategies. It's kind of, what you see is what you get. Their indices are very well defined. They're beating the Alpha Architect Global Equity um, strategy. And I know a year and a half isn't long at all, but for strategies that are supposedly comparable and trying to do the same thing, because the target weights of the global equity ETF from Alpha Architect are 25% each, and they've got a domestic momentum and international momentum, domestic value and international value. So, it should be comparable. It's the same conditions, testing the strategy. So this is a fair comparison. And just using those big box ETFs that don't try and overcomplicate things and keeping their allocation relative to one another static at 25%, with just annual rebalancing, it's got significantly better cumulative return, significantly better max drawdown, better average drawdown, better Sharpe ratio by far. It's got a little higher volatility, but hey, when you're getting that much benefit, it's worth the price of admission, in my opinion. Uh, so my takeaway here is that the strategies from Alpha Architect do not compare favorably to peer strategies from that can be built from the ETFs of other providers, and the data bears that out. I mean, the facts are the facts. And to be thorough, really thorough, I created a third portfolio that takes each of Alpha Architect's equity factor ETFs and weights them at 25% equally, just like I did with the iShares equivalent ETFs. And I went with annual rebalancing, so no fancy relative strength analysis, nothing like that, just holding each of them at a 25% weight and not shifting that based on any signals. And what's fascinating is Alpha Architect is losing to itself, because AAVM is supposed to be implementing an improved methodology that focuses on funds that are doing well at any given point in time and overweighting them and underweighting funds that are not doing well. And we could see that the correlation between AAVM and the third portfolio is, it's pretty high. It's 0.993. So they're virtually identical here. And you can see that they're virtually identical based on their shape. But that third portfolio is doing better than the tactical ETF that's supposed to combine these four ETFs in a way that improves their return and risk profile. Um, and it's just not really working out that way. I mean, AAVM has a worse Sharpe ratio than holding each of the Alpha Architect ETFs individually in equal weight to each other. It's got worse volatility. It's got worse longest drawdown. It's got worse average drawdown, worse max drawdown, worse returns. So, yeah, that's really not what you want to see in an ETF that is designed to improve upon your other offerings. Before we close for today, I want to address two questions I anticipate I'll probably get in the comments and I didn't address during the video and simulation segments. First, why did I use iShares instead of Avantis for the value fund comparisons? Well, because Alpha Architect sticks to more of the pure academic definition of value and doesn't have the same sort of profitability and investment screens as Avantis. So iShares is the better comparison on methodology. Second, isn't iShares more large cap tilted while Alpha Architect is small to mid cap focused? So is the comparison really fair? Well, that's true as far as it goes, but it doesn't address the larger concern of how Alpha Architect's global equity factor ETF strategy is underperforming its own funds held at equal weight with a correlation near one. And the divergence really shouldn't be that large between it and iShares because iShares does include mid caps in its universe. So, yeah. I hope you enjoyed today's video. Don't forget to like. I hope you enjoyed today's video. Don't forget to hit that like and subscribe button. And let me know what your thoughts and opinions on Alpha Talk. I hope you enjoyed today's video. Don't forget to hit that like and subscribe button. What are your thoughts and opinions on Alpha Architect? I love hearing different perspectives. Share them down in the comments. Well, I'll catch you next time.